Let's talk Indian markets and let's connect the global dots with Rana Gupta, Indian equity specialist with Manulife Asset Management. Rana, good morning and thank you for joining us. First, let's talk about the broader market mood, and the broader market mood is that there are no triggers in the system which will generate upside momentum.
Sure, I think that's one way to view the market. We take a slightly longer term view of the market. So to take a step back, the economy was bottoming out even before the elections, and the elections happened. There was a great trigger around that. The rally happened in the market. And we do think that the current government is taking all the right steps, although brick by brick, and that would be very good in the medium to longer term. However, it has to be said that if someone expected sweeping reforms, their expectations need to be recalibrated. And if that leads to some sort of consolidation in the market, that should be seen as an opportunity for the medium to longer term investors.
Rana, hi, morning. How do you think the markets are going to read the key takeaways from Prime Minister Modi's inaugural Independence Day speech? No major welfare plans announced, as has been the trend in the past as well, but clear and precise focus on more fundamental causes which are plaguing the Indian society right now.
Absolutely. So that's what we mean when we mention the reform steps are taken brick by brick, or the administration, the governance steps are taken brick by brick. Although we must highlight that for the stock market perspective, I think there's one thing which was mentioned in the budget about make in India. This manufacturing export is one sector that should do very well also in our view. And let me take a moment to explain why. Now, with Indian rupee, with US dollar falling to 60 rupees and falling to 60 to a dollar and stabilizing about there, India has become quite competitive in terms of cost. India has fair amount of engineering talent. So when we talk about value-added engineering exports, automobile, light industrials, India can be a major hub for that. And we are already seeing companies expanding their gross block to capture their opportunity. So I think that is one opportunity which looks very interesting in the equity markets also.
And if I look at the trade orientation, there seems to be a distinct shift in market behavior. If you talk about Indian stocks, quality stocks are making a comeback, high beta stocks and cyclicals are taking a backseat. Do you think that trend is here to stay? See, I think if you look back from 2013 last quarter till about 2014 first half, the beta stocks, the high beta stocks have rallied a lot. So we do think the easy hanging fruits are gone. So the quality stocks will do better from here. Also, let's look at a post-election that so-called defensive stocks have done better than the cyclical stocks. Now, is that back to the old trend of 2011-12 and maybe the first half of 13? We do not think so. We think cyclical stocks will do better. However, the focus has to be on quality. It's not that we do not like all defensive stocks. Even within what is defined as so-called defensive, we are quite optimistic on IT sector, where the growth and the value equation is quite favorable to the investors. However, in pharmaceutical and consumer staples, the growth value equation in our view is not that favorable. Within cyclicals, we like autos, we like banks. However, industrials, which is another cyclical, there the stand has to be much more nuanced, because within industrial we like the short cycle cyclicals, some of the infrastructure names, and there are many names you can find within industrial which are linked to manufacturing export, a theme which we mentioned earlier. We do think in industrial the long cycle capital goods, the EPC companies, they will take some time to come back, because the private capex, even with all right steps, will take some time to come back.
So what's the sense that you're getting about the market right now? Does it seem like near term we may have reached the top, and perhaps 7,800 thereabouts could be the top end of the curve, at least for this year? Or do you think there are further meaningful gains to be made from here as well?
See, I would not be able to comment about specific market levels. However, what we would like to highlight that there could be some consolidation near term. However, over the longer term, see, what we would like to highlight is that markets are trading at valuation which is reasonable, which is in line with the past. What can be the trigger going forward, and that can take some time to play out, is the earning coming back to the market. Now, if you take a view of FY16, FY17 earnings, whenever that starts getting discounted in the market, maybe in 6 or 9 months from now, FY16, FY17, we are very hopeful on the earnings coming back. If you look at the large sectors in the market, something like a bank, FY16, we do think that slippage ratios come down significantly.
FY17, the credit cost starts to normalize, which will propel banks' earnings growth. Another last sector is IT, where we mentioned we are quite positive because of the spending by the Western companies, spending in the developed world picking up. Oil and gas, another last sector, that the reforms have continued and the earning progression is already coming through. Auto and other consumer discretionary, we have even seen in this quarter the sales of automobiles, air conditioners, washing machine, they have picked up already, and we would expect that trend to further strengthen from here. So earning pickup really coming through in 16-17, and that will take the market higher. In terms of near-term consolidation, of course, that is quite possible, but that should be an opportunity for people for investors who have a around 12 months view.
Rana, so give me a sense of your broad India exposure. Which way are you leaning? Are you buying India-dominated sectors? Are you buying export-dominated sectors like IT and pharma? Are you having a balanced approach? Spill your beans.
Sure. So here the approach is much more nuanced. So we are optimistic on domestic cyclicals. Within domestic cyclicals, we are bullish on automobiles and we are bullish on banks. Automobiles because the demand's picking up and these companies have a lot of fixed costs, so therefore the earning progression when the demand recovers can be quite fast. Banks, as we mentioned, that we are expecting slippage ratios to come down in FY16 and credit costs to come down in FY17. That will propel the earnings of the banks. On industrials, we are bullish on the short cycle industrials like short cycle companies which makes engines, motors, bearings, etc. Also on the export side, we like both manufacturing and services. So we like the IT companies. Also we like the companies which are in the area of manufacturing export. Another theme that I must mention, that the home improvement theme is another theme that we are very bullish on. And home improvement also can be from across sectors. It can be a buying of an air conditioner, it can be buying a washing machine, it can be paint companies, can be cement companies, also can be smaller companies in the segment of ceramics, plastic, pipes, etc.
What do you make of the Q1 earnings? Because Q1 earnings have been a mixed bag. The only bit of surprise has come from IT and some pharma companies, but rest of the growth from rest of the basket has been pretty much muted.
Sure, if you look at, I agree, IT and pharma companies have given good numbers. But even if you look at the cyclical earnings, automobile and air conditioning companies, white good companies, home improvement companies that we just mentioned, their earning has been quite solid. More encouragingly, the guidance have been quite good. Now, the other sector, the banks, the earnings will take some time to come back because this earning is still of the earning of the past 3 months. The real economy will take some time in picking up. So we see in spite of the earning results, we still see greater opportunity in the cyclical names. As you mentioned earlier, that among the so-called defensive sectors, IT is one sector that we still like.